other and then go
Yeah,
from
thank
there.
you everybody for coming. We're really excited that you're here, and we're really excited that Sumit is gonna share with us. She's a certified CPA, good friend of Nick's, and pretty awesome. So we want this to be as collaborative as possible. We have some questions that are already going to be addressed, but please feel free to jump in if you have questions. And I figure we'll take a little time here to get to know one another. So if you want to give us your name, what interests you in real estate, and what experiences you're after and have had. Yeah, we can just go from there. So like I said, my name is Josh. I work with the GPS renting team. I've been a real estate agent now for a few years. I'm interested in duplexes, triplexes, fourplexes, and then obviously working in property management and residential resale. So let's go ahead. I'm going to call on people as they appear in my screen. And if you want to introduce yourself, great. If you want to pass, that's fine too. But we're really excited that everybody's here. So how about Brian? Yay.
Hello, good evening. I'm Brian. I'm here because I love to be here. I'm here for more just for fun, because that's what real estate is all about, fun. I think it's fun. Tenants are fun. Buying and selling is fun. No, it's not. It's not fun at all, but it's a lot of hard work, and you know, it's worth it. As anything that's worth doing is it's you know, it's something I recommend to anybody that has the means to do. So that's why we're here. I invest, been doing so for years, and I'm a real estate agent as well. I mostly work on properties. I know a lot about houses and buildings and how they function and how they work, and so that's where my expertise is. I manage my own rentals, my own properties. I don't self-manage. We do it through the company, but I've put my life into doing this kind of work, basically managing properties. That's what I'm a professional property manager. That's what I am. So that's me in a nutshell. Thanks.
Thanks, Brian. How about our guest all the way from China? You want to introduce yourself?
Don't know.
Yeah.
I don't know what's.
Hello. You don't have to if you don't want to. We just want to tell people your name, maybe.
Me?
Sure.
Hi, this is Yihua. I'm from Bay Area. I am totally new to real estate. Seattle is one of my interested area, alongside with Austin and Denver. So for the tax is always a big problem to start my own business. That's why I'm here. Thank you.
Thank you so much for being here, and you know, it's exciting to start. So how about Ken?
Hi, I'm Ken. I'm real new to real estate. Can you hear me?
Yep, you're good.
Okay. And I've taken a couple classes on how to evaluate properties. My main interest is multifamily. I'm looking at large apartment complexes. I have yet to purchase my first property, but I'm excited to get going on it. I basically got into this because my girlfriend, who is from Cambodia, her dream is to be in or to own some apartment buildings. So
awesome. Thank you so much for being here, Ken. How about Dan?
Well, hello, everybody. My name is Dan. I am in
Portland, Oregon, but looking to buy my first house in Vancouver, Washington. My goal is to buy a house, live in it for a couple years, buy another house, rent that first one out, and kind of move up the ladder, like that. So I'm just looking to, learn from people who have a little bit more experience and knowledge in real estate because I've never bought a house before.
Awesome. Thank you so much for being here, Dan. Is it Natalia?
Hello, everyone. So I guess we're doing the introduction. Natalia Klauer, my husband and I, we have Dwell Solution Company, and that we opened for the purpose of investing into real estate. At this point, we don't have anything in possession, have not closed the deal yet, but would be looking in fix and flip, storage investment, don't know yet. Maybe wholesaling multifamily property or something like this. But gearing up, what else? At this point, just want to understand a little bit more on a tax, and hopefully the discussion today would go a little bit more than just level 100. So look forward to that.
Awesome. Thank you so much for being here.
Absolutely.
Alban? You're mute. Okay, let's
Oh, hello.
Sure.
Yeah. So my name is Hao Bang, and I'm new to GPS, and I currently taking in the road for marketing, and yeah, I'm also really interested in investing as well. In the real estate side, so I'm always have passions on it, and I'm looking forward to learn from each other, and yeah, expecting more as well. So yeah, thank you.
Thank you. Dimitri?
So I'm Dimitri, originally from California, just moved up to the Washington area. So I had a property that I was living in that I knew eventually I'd want to rent, and me moving out here kind of forced me to end up starting to rent that property. And I'm starting to learn a lot just in working with the property management company that I have out there working with me, and different things there. So with this, I've been trying to learn more about it formally, or just more information about real estate overall. So I've been listening to some podcasts and just kind of trying to self-learn. But one of the things that a podcast I was listening to was mentioning joining meetup groups to kind of learn more about real estate, and how you could, take advantage of some of the different aspects of real estate overall. So my whole goal is to just kind of take in information, learn, and then try and eventually get a second property, which would be somewhere out in this area. Don't know where yet, but trying to figure out, some of the best ways to start approaching that and everything as well. So I have a property kind of by fortunate opportunity, but I'm learning a lot very quickly about managing that property.
I'll bet. Thank you so much for coming to our meetup group. We're really happy you're here. Lucy? Jeff?
Hey, Jeff Quinlan here. Can you hear me?
Yep.
Hey, thanks. Yeah, just joining tonight. It's been a while. I may have to drop off a little early, but I wanted to join. I have, excuse me, I have properties or investments in Spokane and Seattle, and just looking to listen in and learn. As it sounds like you got a great speaker tonight, so I just look forward to hearing from each of you and learning from the speaker. Thank you.
Thanks, Jeff. Yulia? Dun Shu?
Oh, hi, this is Dun Shu. So I live in California, and I have a couple rental property in Washington State. Mostly interested in single family housing, but also looking for other opportunities. Try to learn from other people. Thank you.
Good to see you. Let's see, Yu Lin. Okay. Looks like we had a couple more people just join. If you wanted to introduce yourself or if I missed you, please feel free to speak up. We'd love to hear from you. Anybody that we missed or that just joined that wants to introduce himself? Okay, how about Nick?
And me?
Yeah, you.
Oh, okay. So yeah, my name is Nick. I'm with GPS Renting. And then I always introduce myself by saying I'm 100% made in China. And then I was shipped to America in 2007. So I got my MBA in North Carolina. And then I moved to Seattle to work for Microsoft to work on their planning and the marketing. And I just stumbled upon real estate investing because at first getting a good job and then getting good salary was my American dream. And then I realized, so when I graduated with a huge student loan debt, and then I bought BMW and doing all those things. And until I met Brian and I realized, and then we started buying properties from that time. And then so I realized cash flow is the king, buying properties that will appreciate while it's a way to build wealth. So Brian and I, we are fortunate in the last few years, we have been continue buying property every year. And that's a great journey. And then that's one of the reasons why we want to do this kind of meetup is to share some of our experience and learning from other people as well, how they're investing, because real estate is so fascinating. There's so many ways to do things. So yeah, some of my project that I'm trying to work on right now, one is syndication by either hotel or apartment complexes. And then the second one is building something. Anyway, that's, and then while continuing acquiring properties, mostly single family and small multifamily. That's our niche. I think that's it. And great meeting everybody tonight.
You want to roll that into the vision and scope?
Sure, sounds good. So yeah, thank you, Josh, for going around the table, let everybody introduce each other, because that's our goal. Our goal is really bring together a group of like-minded people and then who are action-oriented, and we want to help each other. So on one side, every time we try to bring investors themselves, also bring like CPA today Sumit to talking about taxes. At the same time, we really appreciate it if we can all share experience and have the open mindset to learn from each other. I do think that's the main goal of doing this. And we will host this once a month. And then, yeah, and that's our vision and the scope. The next one.
Yeah, so normally we fire stats at everybody at this slide every month, but I thought instead Nick came up with a great idea that maybe if you have a crazy story about what's happening in the real estate market, or what have you heard, or we'd really love to hear from you about what do you think's going on out there right now? Does anybody have a good take or story?
Yeah, what we want to do is before we all show the stats, it's like, oh, this is an inventory number. This is a day on the market. And then we're like, how about listen to other people, like what you have heard recently, because we're all into real estate. What have you heard anything about real estate? I can start by sharing, because we are in property management. One side of our business, we're in property management. So it's, what we have seen is apartment and condo rental in Seattle horrible. I've never seen this to be so horrible. Like there is a condo we manage right by in Capitol Hill, right by Cal Anderson Park. We dropped the price already like $500. And then, but after over 3 months, there's only one inquiry. There's not even a tour. That just shows that people is really, really moving out of the city, and then they want bigger space. And then the condo rental market, and also for sale as well. We have another property for sale on top of Target right by Pike Place. And then it's the same. We list over almost 2 months. We are already the cheapest one in the building, but even nobody even asked for it. I mean, there are 3 or 4 tours. That's it. The condo market it's really going to the winter time. That's at least what I saw.
Okay, I can speak up from California, I guess. So I'm personally I'm located in Los Angeles. I'm actually in the process of closing a primary residence. So I enter market thinking it's kind of competitive, but it's not really that bad right now. I feel like things have slowed down a little bit in California now. In Los Angeles, it's still hot, but for the target I've been looking, it's relatively high. So like I was looking around like 1.5 million single family house. So at this price range is not competitive. I mean, I bid on the house I want, and there was like another person bidding, and the seller countered them. They never came back. So it's not as competitive I think it was compared to Seattle, at least. Like Seattle was still super crazy. It looks like. So that's Los Angeles. Also condo seems to be on the market much longer than single family for sure. And I see all the condos near me, like they've been listed for like quite a while, and it's not going that fast. And I've heard from my agent friend that Bay Area is also pretty slow, probably slower than Los Angeles right now. So at least California is not doing as good as Seattle, just from single family perspective. Yeah. On the other hand, I think my rentals in Seattle, those single family ones are still renting out pretty quickly. Honestly, I've been very impressed. Of course, like GPS did a good job, like getting it to stage and getting the tool and stuff. So thanks for Nika and Brian for taking care of this. But honestly, I was super impressed by how fast my single family property in Seattle got rented out. Yeah.
Yeah,
Thank
I think you recently bought 2, right? Both
Yes.
in the north end. One got rent out, I think, around a week, and now we just closed the second one, and then we just put it on the market. Is that the past weekend? Is that right? And then
Yeah.
already having application and then ready to.
Yeah, it's pretty much like within a week or 2. Yeah, I was really fast.
Yep.
Well, it seems very consistent with you guys are describing. What I see hot, I see the investor frenzy really, and it's in that $400,000 to $600,000 range, where the competition is stiff. I think mainly fueled by investors who is trying to snatch the lots, and a lot of it for not fix and flips, but for built out new ones. Fix and flip is it's really hard to find, basically, at this point. And it seems with the change in Seattle of the law and permitting requirements, where you have to, S400, 500, where it's 5,000 square feet lot, you cannot build more than 50% of that lot. So you cannot build more than 2,500. The name of the game is you basically build dados nonstop. And so every lot has 2 things, and then you deal with the either put them in condo association and sell them separate, or you sell them both together. So that's what I see as a trend as far as in Seattle. But East Side is still the same. The builders are looking 600 up to 600 lots that are flat to buy it, and then to build the $2.5 million house. So that seems to still sticking around.
Sorry, just personal question. So when you're talking about the 2 things, the first thing in Seattle, are you saying that's a new law? It's about
Not particularly that new. I think it went into effect in February.
Oh, okay.
Nothing to do with COVID. They were changing the built out the development rules. I was just looking at the property in Greenwood, and so that's how I was researching and talked with the builders that buy the lot and they built it out. And indeed, on the city of Seattle, when you look at the permitting, what can you build on the lot? If it's S500, S7,000 700. So 5,000, 7,000 lots, you can build the new building, brand new one, if you level it out and not refurbish. You can build, and the property can occupy up to, but no more than 50%. So that limits, like in Seattle now, in Seattle proper, in city of Seattle, you cannot buy a lot and build a huge one on it. So.
Thank you.
Hi, this is Dan. Like I said, I live in Portland, but looking to buy in Vancouver, and I'm seeing that the there's just not a lot of a variation between the houses that kind of need to be fixed up and the ones that already are fixed up. So I'm looking at the houses, and I'm trying to figure out how I would buy a house that's enough below market value to invest, get it fixed up, and rent it out and actually have it cash flow. Unless I come in with a very large down payment, but then that ties up a lot of cash for other things. So I'm wanting to figure out how people do this, because I'm not seeing the inventory. In Portland, there is the inventory, and maybe that's because it's an older city, so there are older houses and there is that opportunity, but I'm not seeing that as much in Vancouver.
Washington is not, well, I guess Nick will have more experience, but to cash flow, you need to go to Texas or some other places, not here. Here it's appreciation.
Yeah.
So it, like, you're not seeing something wrong. It's not like you're missing it. It's actually not there.
And,
Yeah,
and
for
I would,
us, it's
I would be
always-
okay if it was just like a couple $100 to cover the cost of like just maintaining it. But you know, if the houses are renting for $1,800, $2,000 a month, and they're selling for $375 to $425, there's not a, like, that's about a break even. In fact, the mortgage might even be a little bit more expensive than the inventory. So I'm interested that, like, it's interesting to me that you're just saying that's just the way it is in Vancouver, in Washington State.
It's in Washington. So there is a website. I keep forgetting the name, but you can see nationally what the houses are renting, what the caps are for single family throughout the nation. And, you know, in Philadelphia and Texas, it's
Washington, we do have a cash flow area. It's called Aberdeen Hoquiam.
That is
there's a neighborhood out towards Ocean Shore, is a whole area that cash flows pretty well, I think. We haven't purchased anything out there, but you can buy houses for $100,000, $150,000, something like that. And I'm not sure exactly what the rents are, but I believe there's some pretty strong cash flow out there.
That's what Brandon Turner is coming from. That's where his investment is, like, all there, right?
so. Yeah, I'm not saying it's like a blank rule, but from just Dan, from perspective, you're already trying to consider a different state, like going several states out. It probably is not that big of a stretch.
Well, Portland and Vancouver are right next to each other. So
Yeah,
my wife, she teaches in Portland, and my job is in Portland. So, or it's in Vancouver. So it makes sense for tax purposes to move to Vancouver because they don't have income tax. So that's kind of why I'm thinking, why not just go to Vancouver? But if my only thing was real estate, then yeah, I think there's probably other places in the country to go. But I think I might be stuck here.
Dan, for someone like you, you mentioned you wanted to sort of start small and climb the ladder, I think. Looking for properties that maybe are in some disrepair, if you can live in them and work on them and also rent them out at the same time, you can find like non-conforming multifamily units, like non-conforming duplexes where you can rent out a portion of it, live in a portion of it, get it fixed up, do that sort of thing. And of course, the more bedrooms and bathrooms you have, the more rent you're going to the more rent you're going to get. It doesn't necessarily mean the size of the home, but if you have the capability to live in a property while also renting out a portion of it, that's where you might find some good cash flow. And of course, being in disrepair and being a non-conforming building, oftentimes those scare investors away, and so the price is a little bit cheaper. So you get them for cheaper to begin with. but the potential sometimes can be much greater. There's a little bit more risk involved, but it's a good place to start out.
Brian, what is non-conforming?
It's basically a house that's been chopped up into separate units, like Natalia was talking about ADUs and things like that. Maybe they have extra kitchens. You know, you have like a split entry. It's a really good example. A split entry is the most common that you see, where you have a lower portion of the house and you have an upper portion of the house, and somebody has added a kitchen downstairs, and you could essentially rent out the lower portion with a kitchen and a bathroom and a laundry room, and then you could live in the upper portion with a kitchen and a bathroom and a laundry room, that sort of thing. So, yeah, that would be a non-conforming multifamily building.
Gotcha.
Another thing I just want
more risky, but they do provide more potential for cash flow.
Yeah, one additional thing, Dan, I just want to share. I do think a lot of time when we're looking at the property, it's also not just those hot homes. Those are what everybody is looking after. When we're looking, we always look for properties that sometimes maybe haven't been on the market for a long time. And because of maybe the listing agent was not doing a good job marketing the property, or for some other reason, they didn't see well. Like this year, we acquired a property. It's a duplex in Northgate area. It's pretty good in Seattle. But in the listing, it's duplex, so they use the worst side of the photo. Everything looks horrible, and the rent they put it on the listing is $850 each side. It's a 2-bedroom each side. It's townhouse style, but flat. But what we are looking at it, we say, oh my gosh, this can easily rent around $2,000 rent. So a conservative is $1,500. So that's where we go in and then negotiate. So we bought it for $460. And then rented each side for $2,000, and the mortgage is only $2,000. So anyway, I do think there's still opportunity. It's just when you're going into it, look for not just the ready to go house, but also something like you might want to do some sweat equity.
Yeah,
to make
and that's exactly what I'm thinking.
Oftentimes houses can be relisted as well. People will go in there with an inspection. An agent maybe not doing a very good job will accept an offer with an inspection, and then the buyer will back out for whatever reason, and then that will affect its marketability. And so oftentimes when properties come back to the market, sometimes those are the best opportunities, because they've already seen their initial surge, and then they've scared people away because they say, oh well, somebody else didn't want it, there must be something wrong with it, you know, and those can be sometimes the best deals, properties that have come back to the market. So look for those, that sort of thing. But real quick, I think the question that was asked, or what are we seeing? Mostly, I think suburbs are the way to go. People are purging from the cities a little bit, and definitely Nick's point of the condo markets in the big cities, especially Seattle and Portland, and areas where we've seen a lot of bad activity, and you know, the COVID has affected. Those people are really being disinterested in those areas, and so that's pushing everyone out. Of course, people are able to work from home now, and so the suburbs are the new hot market. So whether you're looking for single family or multifamily, you know, you're going to start to see more appreciation in the suburbs than you are in the downtown areas, I think. And we've already started to see that. We have areas, you know, 15, 20 miles outside of the city that are now almost as expensive as the city itself. So the demand there is very hot, whether it's for multifamily or for single family. So if you have the means to do so, get in those suburbs, the suburbs of the big cities, because that's where people are moving to.
Okay,
Thank you.
shall we? Any other thoughts people want to share, or we can move to the text discussion, right? Perfect. And then before we do this, I just want to introduce Sumit a little bit. Actually, Sumit is my personal CPA. I feel very fortunate to find her. And then I still remember when I first moved to Seattle in 2009, looking for CPA, go to HR block. And then the first couple of years, I report my own taxes. And then every after I found Sumit, I realized she's amazing in the way she's so humble. Because the taxes changes all the time. Right? When she doesn't know something, she will let me know. She'll go back to do the research and always help me to find out the solution. And then not to mention all the taxes she helped me to save by setting the right legal entity, the structure in the way. So I really appreciate Sumit. I just feel like she's a great trusted partner that I can have in my real estate journey to moving forward. So that's why why I brought her here. So I just want to selflessly share her and with everybody, and then also the knowledge that she have in real estate taxes, and also the ability that she can help to find the answer, even if she doesn't know today. So anyway, so it's all yours, Sumi, how you want to start. I have a list of questions, but do you want to just start from this slide?
Well, thanks, Nick, for those kind words. That means a lot to me. Hello, everyone. My name is Sumit Bedi, and I'm a practicing CPA located here in Washington, Bothell. I have been doing taxes since 1994, and it is my pleasure to join you all today in this real estate meetup program. I have known Nick, as he mentioned, since he was working for Microsoft and was looking to start his real estate investment entities. And till today, we have a great working relationship. And Nick has asked me to join him today in about for these real estate tax questions that several individuals have, as you all have talked about. And I'll try to give as much information, more than level 1 that you are requesting, to the best. And if there is a gray area which I am unable to answer, I sure can take down your email address and get back to you with the specific question that you might have. So real estate in general, it's hard to dispute that real estate is one of the greatest investment with all of its unique benefits. As you all are experiencing being a real estate owners today, or a prospective real estate owners. Real estate is one of the most tax advantaged investment also compared to other investments. Everyone has to pay taxes, and I really say that, and I mean it too. We all have to pay taxes, but how much can we reduce by utilizing certain tax laws that are available to us in real estate is the key element of how a real estate investor should pursue. And as you're all aware, the most tax expenses that can be deducted against your rental income include the basic stuff like property tax, mortgage interest, property insurance, property management fees, your repairs, your ongoing maintenance, could be yard maintenance, and also your capital improvements. In addition to that, if you have to pay someone for advertising, for real estate commissions and so forth, all of that is also included. Along with that is the legal and professional fees like accountants, or if you had to hire an attorney to draft a LLC contract, PO box rentals. Some of them don't know if that is also a deducted expense or not. It sure is. Travel expenses, when you're commuting to even hunt for a property or to meet with your tenant or do a checkup on your property, all of that is also deducted. HOA dues, a lot of you folks have been talking about condos, so there is trade association dues, all of that is deducted. In addition to that, if you manage several apartments or several rental properties, you probably will be able to deduct some admin costs too. Not your own salary or stuff, but admin costs like internet, lease preparation, even meals if you are meeting with a prospective or a current tenant or a partner, if it's a real estate in a partnership to discuss business, that is also deducted. You just have to, in order to deduct any of these deductions, you just have to keep good records of your expenses throughout the year. So you could take advantage of these tax savings that are available to you as a real estate investor. And among all these deductions, the last biggest deduction that's available is depreciation. I'm sure all of you who own property already are depreciating your residential properties at 27.5 and your commercial properties at 39 years of useful life. So what does that depreciation mean to some of you who have not encountered that yet? Assume, I'm going to take a simple example. Assume if you purchase a single family home, it's cost 300K. It's hard to take anything for 300K. So I'm just taking this as a small number so I could do some calculations and keep it simple. So let's assume 100K is for the land. You get to depreciate 200K out of the 300K for a building. This will give you almost $7,200 plus of annual deduction against that rental income. And that's huge. And that's why people like to be in this real estate business, because that depreciation deduction can really take away all of their rental income and turn that positive number into a negative number on their tax return. However, just like everything in this world, depreciation does not last forever. When the property is sold, that depreciation that you have enjoyed as a deduction over the term that you have owned this property gets recaptured, and it gets taxed back to you at a 25% maximum tax rate. One can eliminate that, and the way they can eliminate that is by doing a 1031 exchange, which is very commonly used. The tax benefits of being a real estate owner extends beyond this list, because you get to enjoy the appreciation, the equity buildup, and the ability to leverage your investment. So those three things combined, even if you have to pay a tax on it, I think it's a huge money-making thing for an individual. I don't know, Nick, if you want me to go down your questions list, or you want to ask. I want to pause there for a moment to.
Yeah, I think should we pause to see somebody whether have questions so far from what Sumi has already shared?
So I'll proceed, looks like, but you sure are, feel free to interrupt me, please. I think I have covered what are the deductions for rental properties. So all of those were very common. Let's talk about your second bullet point. What are the passive activity and how does it affect me? Very good question. So in taxes, a normal taxpayer gets taxed in gets taxed on three different types of income. One is earned income, one is passive income, and one is portfolio income. So earned income is, you have a full-time job, you have a W-2, or you have a business activity, or you run a business. All those are considered under earned income. Then comes passive income, and passive income is one that is derived primarily from renting real estate or renting a business property. And the third one is portfolio income, which falls in the passive activity, but not as a passive income. And portfolio income will be your stocks, dividends from stocks, interest from your CDs, sale of stocks, gains, all of that is portfolio income. Passive income is mainly from rents, royalties, or your interest in some partnership, a limited partnership or a broader partnership. Those are the only areas that bring in passive income. And how does it affect one? IRS gives a definition of a passive income is any money that is earned from a rental activity or a business activity in which you don't materially participate, meaning you don't have like a 9-to-5 job. You might go there once a week to check on your property or to fix a faucet and stuff like that, but it is not an ongoing requiring your physical presence or your physical work. And real estate is actually frequently praised on its ability to produce passive income, which is the cash flow that is earned without doing the daily work. So you let that property appreciate while someone else is paying the mortgage, while you're just enjoying all the tax benefits. So it's just lovely way of making money and keeping IRS out of your sight. And how does it affect you? That is really important. The way passive activity works is if you are making $150,000 a year combined, if it's a joint return, or single, if it's a filing status single return, you can only deduct passive income if you are making $150,000 or less against your W-2 income, Meaning if somebody's working for Microsoft making $130,000 and they have a rental property that gives them a positive cash flow or positive net rental income of $10,000. So they'll pay tax on 130 plus 10, which is 140. Let's take that example the other way. If they have working for Microsoft making $130,000 and they have a net rental loss of $10,000, they'll be able to deduct that $10,000 against $130,000 worth of income and pay tax on only 120. But now let's say if another individual is working for Microsoft making $200,000 and they have a net rental loss, they will not be able to deduct that passive loss against their ordinary income because IRS has laid down the rules. It's $150,000 or more. What happens to that passive loss then? It gets carried over and it can be used in the year you are making less than 150 or in the year you have passive income, meaning net rental income, to offset that, and you won't have to pay tax till that loss is used up. Or thirdly, if none of those happens, in the year you sell the property, that bucket full of passive losses that you have for the period you have owned that property can be used in the year of sale, or what they call in accounting terms, a year of disposal. Any questions so far that I need to pause?
Yeah, I have a question about the passive loss.
Sure.
That doesn't include depreciation, right?
Yes, so the passive loss is your net loss after taking into account depreciation. Yes, it does include depreciation. So what you will start your rental schedule with rental income, then you might have mortgage interest, property taxes, insurance, all of those amounts are deducted. And the last deduction is depreciation on your rental schedule. And after taking into account the depreciation, you come with the passive income or a loss.
I have a question with 150. So let's say my income is 140 and my loss on the rental is 140 as well.
So the maximum allowed, very good question. I should have addressed that. So the passive loss that is allowed in a given year, if the income is below 150, is $25,000 only.
Yeah.
I know. IRS is generous, but not that generous. Yeah. So they only let you allow 25 and rest gets carried over till you sell it.
So if you make more than 150,000, then you can't take any of those losses until you sell the house. Is that correct?
Correct. Or unless you generate a passive income. So let's say if someone has owned a home for 15 years, of course, with inflation, the rental income might go up, should go up. And also your mortgage interest will be going down too. So therefore, you do get into people who own the home for like 10-year plus, they will start seeing that the big negative number is turning into a small negative number or a positive number. And in those years, you can deduct those carryover losses and not pay tax.
So like retroactive, like you can say
going forward.
Yeah, so if in like 2010 you bought a house, it's 2020, you're renting it out, you don't have, you owe less money on it, you're paying more principal, and with appreciation of the house, it's cash flowing, then you can take those deductions from like 2010, 2011 and apply them to 2020?
Correct.
Okay.
Okay, so we can move on to Nick's next question on the slide. Is security deposit taxable, and how about last month rent? Yeah, so two components in this question. Security deposit is taxable in the year when the lease term has expired. Let's say you have a tenant and he is leaving in 2020 and he gave you $1,500 security deposit. You might have some provisions in your lease saying that if you break something or if you damage our property, it will come out of your security deposit. So whatever money you have not reimbursed to the tenant who is leaving, the outgoing tenant, it will be taxable in the year that he leaves that property. So if you are refunding him 100% of his security deposit, then 100% of that amount will be taxable in that given year. Because technically security deposit are supposed to be kept in an escrow account and not in your daily working operating account for the rental real estate. So that's why they are not taxed when you have received the money, but when you give it back to them, the portion that is not returned to the tenant is taxable to you as income. And the last month rent is usually given, in most cases we see, is given upon inception of the lease. Therefore, let's say you have rented it out on November 1st, an apartment, and you received 2 months worth of rent, the first month and the last month. You will be reporting income in 2020 for those 2 months, November, December, and the extra rent that he has paid you for a last month rent. So there will be 3 income from that tenant to be reported in 2020 tax year. Hope that's all making sense to all of you. And
Can you
now,
repeat again, Sumit, sorry, the
Sure.
3 income, the very last one.
So in my example, let's say you rented your place out in November, on November 1st of 2020. And the new tenant gives you rent for first month and last month. So those are 2 months right there. And then he pays you for December. So you got 3 months worth of rental income from the tenant to report for 2020 taxes.
Oh,
First month's rent, last month's rent, and then he's also renting it for December too.
I see. So it's only if you're on a cash basis, then you recognize all the 3 months as a revenue.
Yes, so the rental real estate is on tax basis. It's not on GAAP basis. It's on GAAP basis for like big malls or large apartment buildings that are in a partnership. Those are under GAAP accounting. For most of you investors who owns 10 or 15 single family homes or duplex or fourplexes, usually you're always on cash basis. You recognize income when received, and you deduct the expensive in the period it is expensed, meaning you have occurred an expense on your part. You deduct that in that given year.
Okay.
Hello, Sumi. I have a question. Like, do you often do bonus depreciation and cost segregations for your clients?
Cost segregations are done mostly among multiplex buildings. And I deal with most of the clients who are 4-plex, 6-plex, 8-plex. That's the most I do, from single family to a condo to 4-plex to 8-plex. But normally, if a cost segregation study is needed, it's usually either on a commercial property. So some of those strip malls, or like Nick said, that Target building in downtown Seattle. So there's a commercial building on the first floor and there are apartments on the top floors. Those buildings will require a cost segregation, which will help you get the bonus depreciation upfront. But do remember, if you are not planning on owning that building for a long term, you don't want to pay such high fees of doing cost segregation studies because it's cost versus the benefit. It would not help you. But if you plan on owning it for 10 years, you might as well do that. Pay someone, those specialized companies who do cost segregations, and get that bonus depreciation and accelerated depreciation also along with that on that particular property. Okay. So the next one is, how does depreciation on rental works? So I think I have touched on it already, that the depreciation on a rental property, residential rental property, is 27.5 years that you get to deduct. And for a commercial one is 39 years. But if someone owns a property that is commercial and residential, they need to look at it, what portion of income is coming from residential versus commercial. If 80% of your rent is coming from residential, then you will only be allowed to use 27.5 years. And if less than 80% is coming from residential rental, then you will be able to deduct 39 year. Or if it's a separate parcel, we have seen some clients who owns 2 parcels, and then you have to segregate it based on the parcel and the way county has it laid out to determine the exact depreciation on it. And how does the depreciation on appliances work? So the appliances are deducted at a 5-year period across the board, but there's also a provision that an election can be done on your tax return. You have to ask for that election by an IRS, where you can deduct up to $2,500 of an expense immediately against your rental income and avoid any depreciation on it. So if you put in new windows and each window or one window is $2,500, if one bill is for 25, you can just write it off if you choose that election on your tax return as a rental real estate investor. So that
Hey,
works.
Sorry, a quick question on that. When you're talking about 2,500, is that you can, like, for example, I replace one window 2,500 and then another window 2,500, I can do 2 of them?
Yes.
Oh, okay. So it's per
So
bill?
one item up to $2,500.
One item. Got it.
Yes.
Okay.
So if you put in floors for 1,800 and you put in a window for 2,000, yes, you can deduct both and not capitalize it. But you have to apply for that election. It's not automatic. You cannot just put it on your repairs line on your tax return. You have to apply for that election to go into play. It's IAEF election.
So in that case, for example, we will just let you know. I will just let you know.
You just let your tax professional know that
okay.
I have done substantial improvements and most of them were under $2,500. Can I expense? It could be 5 things aggregated to 10K, for example. You can deduct that whole thing against your rental income in that given year.
I see. Thank you.
I have a question. What if the one item is more than 2,500? Will it
then you are not eligible for that election. You
Got it.
have to capitalize that expense.
Okay.
And I must say this one more thing in addition to that, just to clarify that, because I don't want you to go home with any doubts. For some of you who are thinking about flipping the homes, it will not be eligible for you to do this because then it gets added to the cost basis, and that depreciation will give you a same result as an immediate expense, because if most of the time we see flippers are done within a year or year and a half. So unless you're planning on owning that building as a real estate investor for a longer period of time, this election is more useful for those individuals and not for flippers.
I have a question about that. One of the things that I'm most worried about now is my debt to income ratio. So I make plenty of money, like more than enough money to buy a home, but then my business expenses, I am debating on depreciating them versus writing them off this year because because I want to qualify for higher loans, right? So in this example that you're talking about like writing it off so it makes it to the IRS as though you make less money. And it seems to me like there are circumstances where that might not make the most amount of sense. Am I understanding that correctly?
Unfortunately not. And it's my fault because I should have said that. This depreciation deduction that I talked about is not optional. Remember that. It is not optional. If you own a real estate and that is generating rental income, or even if it's just as a real estate investor where you have an intent of earning some income from it, a depreciation deduction is required by the IRS to be taken. So they give you this freebie on the table today while you let your property appreciate as an investor. But when you get rid of that investment, that depreciation gets recaptured. So we get a lot of clients, I would say 50-50, who think depreciation, just like you said, that, oh, it's going to hurt me in obtaining another loan and I'll show a negative number, a big negative number. I don't want to pay them back 25% when I sell it. I don't want that headache. It is not optional, it's required. So for individuals who have owned properties for a couple of years or 5 years and have not taken depreciation deduction for the years that they were receiving rental income, IRS upon sale can still tag you with that 25% depreciation recapture, because just because you failed to take it, you failed to use a deduction that was deemed necessary for you given the law, and you forego to take it, you still, they can challenge it, and you will lose on it, that you didn't take that deduction and oops happened, and they're like, that's okay, you still have to pay us back that 25% depreciation. So it's very important. It's not optional. It's not your choice. You have to take it. And on the other hand, the lenders who are smart lenders, they see that depreciation deduction is a required deduction on one's taxes. So they will, it should not come back and haunt you against your cash and debt ratio by itself. There might be other factors that affect debt ratio, but depreciation alone will not be, because there's a line on your tax form that says how much was your net rental income apart from depreciation. And that's the numbers these lenders should be looking for. And smart lenders, like I said, will look for that. People who do real estate investor loans day in and out.
Thank you for that, Sumi. What if I really didn't do the depreciation right in the past 2 or 3 years? Is it possible that we amend the tax file?
So if you have missed it for 1 year, the first year, yes, you can do amendment to it. But if you have missed it for several years, like you said, 3 years, then you file an additional form called 3115 to recapture the missed depreciation, and you get to deduct that in the year you have found that error. And it is optional for IRS to either approve it or disapprove it. It does require that approval from the IRS, but you can take that on a form 3115, which is strictly for missed depreciation to be captured now going forward.
Thank you.
Yeah. So I guess I can move on, Nick, with your next question. For a property that was a primary resident, but now it is an investment property, how does depreciation works? Yes. So let's say I own a home for 5 years, and then I moved out to a bigger home, and I am renting it out now. My depreciation will start the year that property converted from a primary residence to a residential real estate investment property. So if I owned a home from 2019 to, I'm sorry, bad example, from 2015 to 2019, it was my primary residence. And then I converted in 2020 to a residential rental. My depreciation will start as of 2020, not as of 2015. And what will be the amount that you will be able to depreciate? What will be the value? It will be whatever I originally paid for that residence as my primary residence in 2015, and whatever capital improvements I have made on it. Let's say I built a patio, I put in a new deck, a new furnace, I put in wood floors, remodeled the bathroom. All of that will get added to a new value, and that's the amount you get to depreciate once it's upon conversion. What is the primary residence exemption, and how often can I use it? So the primary residence exemption is $250,000 for a single filer, and $500,000, meaning $500,000 for a joint filed return. You have to own the home for 5 years and lived in it for 2 in order to claim this exemption. and you can reclaim it every 2 years.
Hey, Sumit, I have a follow-up question on that. So what if I live there only, sorry, I own the home for 2 years, or, you know, and then I sell, or 1 year and then I sell? Will that work?
Yeah, so if you owned it for 2 years, you'll get the full 500K if it's a joint return exemption. But if you owned it for 1 year, then you get the reduced exemption amount based on what your gain is and the number of days you lived in it.
Got it.
So they take a ratio of that gain with the number of days you have lived in it. So it's not like 100% all gone, but part of it is gone.
Got it. Thank you.
And how much tax is withheld if a foreign owner? Very good question on that too. So foreign investors on a real estate pay 15% tax, and they fall into the rules and the regulations under IRS tax code called FIRPTA, if I'm pronouncing it right. It's Foreign Investment in Real Estate Property Tax Act. So there was a new act that came into play in the IRS code, which is FIRPTA is the short form for it. And you get to, IRS requires the escrow companies to withhold 15% tax. That doesn't mean that 15% tax is withheld, that you will be able to lose it all. If it just requires you to file the return, that way the foreign investor doesn't forget about IRS and takes his money from this foreign investment and goes back to their home country and don't pay the tax on the income they have earned. A lot of time we have seen in 2008 and 7 that there was a net rental, instead of having a net income, there was a net loss. And not only that 15% came back, but more came back as a capital loss also. So escrow companies do their due diligence on making sure that the foreign investor pays that 15% tax. It's just a withholding. It's not what your total tax. Your total tax could be more than 15%, depending on what other investments you have in this country. And if it's more, then you will pay the difference. But if it's less, you will get your refund. What is the tax? What is the capital tax rate on the capital gain? So the capital gain is incurred when you sell a property that you purchased it originally for a profit. Capital gains can be short-term or long-term gains. Long-term gains are typically lower than the ordinary income tax rates. Short-term gains, which are for properties that are held for 1 year or less, can range anywhere from 10% to 37%, depending on your income tax bracket. And the long-term capital gains, which are properties held for 1 year and 1 day, that is the most favorable tax, which is from the range of 0% to 20%, depending on your tax bracket. But in order to avoid, just to go a step further, in order to avoid these capital gains, or short-term or long-term, you can utilize one of those tax-deferred methods of investing in real estate and avoid paying any capital gain, meaning zero. And that is Section 1031, which is mostly seen by investors who are, core investors. They want to be a landlord for the rest of their life, whether they are owning a property A, B, or C, or all of them. So 1031 is a really good tool to forego all of these capital losses or capital gains, in addition to the depreciation recapture that is supposed to come back and haunt you if you just sell it, a single property or multiple properties, and not fall into a 1031 exchange. Is there any income tax difference if I transfer the property to the LLC? No, there is no LLC difference between an individual owning it Yes, there will be some difference if that LLC is owned by a partnership versus you owning a property individually at the first place, and then it goes into the partnership, then it flows into as a pass-through entity. So you will file your partnership return, you'll get a K1 from it with the net income and losses on this rental property, and then it will get added to your individual 1040 tax return. I'm going to come back to syndication in a minute, but I want to highlight a little bit about 1031 if we have a few minutes. I think it will be a useful tool for all of you to grab that information. If you ever go into the IRS tax code, and it's a section called 1031, just like the way it's called 1031 exchange, it's a legal transaction that allows a real estate investor to swap an investment property for another like-kind exchange, while you will be able to avoid your capital gains, the depreciation recapture, and so forth. So you might be in a real estate investor where you have an old building that you know they will do special assessments for, and you want to just get out of it, but you don't want to pay Uncle Sam. You still want to be a landlord, and you want to be in this business of in real estate investment. You could do a 1031 exchange, find a like-kind property. It can be residential to commercial, commercial to residential, no problem, or a land to a land. So an undeveloped land where you intended to have it for a business purposes, but you never built on it, but you found another land that already has work in progress where it's about to, foundation is laid out and it's going to be a multi-rise, you sure can do that. A 1031 can only be done on an investment property. It is not available for your primary residence that's converted into or not. So it's only on an investment property. However, it can be a commercial or residential and so forth, but it has to be with the intended use of business purpose. The other thing that some of the states have, and most of the states have, I should say, is that new opportunity that came for real estate investors that's called opportunity zones. So you might have seen some of the real estate agents are advertising a property and saying, hey, it's in opportunity zone, like it could be Wenatchee and, like Eastern Washington, some of the areas in our state do have that too. Texas have several. So it's underdeveloped areas where there is more opportunity. President Trump signed into law in 2018 a new act that was called Tax Cuts and Jobs Act, which allows you to roll over your capital gains by buying an investment in an opportunity zone fund, where you could defer part of the gain, or it can be eliminated 100% depending on the tenure of the property that you are holding. So it's a whole different new ball game that just started, kind of less than 18 months ago. And a lot of real estate agents you will see that are looking to advertise it. Oh, it's opportunity zone. But for a long tenure investor who is not going to flip, this is not a concern to them, good or bad. So I want to move on to Nick's question, and he said, he's looking to do some work on syndications. So syndications are usually, most of it, it's like crowdfunding. 15, 20, 100, 200 people get together to buy a bigger project that you and I individually cannot afford to buy, but we can buy a piece of that pie for it to grow for our future. It is normally, we have seen syndications are always under an LLC in the form of a partnership. So the company with whom you are investing for that motel or a multiplex or big malls and stuff like that, they will be issuing you a K1 every year from that partnership return. And they will also be giving you a distribution from the income, that net rental income that's being generated. The distributions that you get from that partnership are not taxable to you, but that distribution does reduce your basis. So if you have contributed 100K, for example, in it, and every year they're giving you $5,000 as a piece of that pie from the earnings that it's doing, your basis in that property is being reduced from 100K to 95. And when you sell that share of your in that LLC, usually it's 5 to 7 years we have seen for most of the crowdfunding projects. You will be taxed as capital gains upon sale. This entire activity will still fall in a passive activity rules. But that basis that the income that you have earned will increase the capital gain on that property that you have enjoyed it for 5-7 years of getting some distribution. Like everybody might say, oh, I make $7,000 to $8,000 or 7% or 8% on my crowdfunding investment from this real estate. And they're mostly in the form of REITs, basically. So it's a whole different industry than the normal mom and pop landlord and tenant relationship. It's much larger investment and you are hands-free on it. Someone else is managing it. They decide when to sell it. They decide when to make capital improvements to it. They decide whom to rent it. So all the decision-making is on their plate versus at present, most of you do it yourself or have Nick handle it through his GPS renting. Anything that I missed that was on here?
I have a bunch of questions on.
Of course, please go ahead. I'm open for it. Go ahead. I'll try my best.
Nick, I'm sure you have plenty, but so through this indication, one of the attractive features of it is the depreciation, because as a partner, you will get a portion of the depreciation. Can you talk about that?
Yeah, so the partnership LLC will take the depreciation into account. So let's say it's $1 million rental income. You get to deduct the mortgage. I mean, they get to deduct the mortgage, the property taxes. It's going to be the same deductions that you get to enjoy today. And after that $1 million, depreciation is also a part of deduction. And now
so it's basically net income of LLC that gets distributed via distribution to the partners.
Yes, so it's not from the distribution is your net profit on that net rental property. It is not in addition to the depreciation. Depreciation has already been deducted.
Yeah, that's my thing.
Okay, so if you start with $1 million, you have mortgage insurance, subtract that. You have property taxes, subtract that. You have insurance, you subtract that. You have management fees, you subtract that. You subtract depreciation. And whatever is left, it's called net rental income or loss. And that will be the distribution you will get on your K1.
Okay.
As an investor in that.
Okay. Just to complicate it just a tad. So you said it's passive income, right? But if your normal whatever earning is above 200 or 150, as you said, then what type of income does it count? Is there?
Okay, so you from that LLC, the K1 that you're receiving, if it has a net rental loss, the loss will still be passive loss. The type of loss does not get changed whether your property is in an LLC or a non-LLC, if it's in a partnership or as an individually owned. So the title of that loss will still be passive loss, and you will be still taxed in the same manner of passive activity rules, just like what we talked about it. You would not be able to deduct that against your $200,000 of W-2 income.
Is there a different tax rate for the passive income?
No.
Like capital, I know it's different, but for
the cap is different. So let's say 10 years from now, when the tax rates are, what we are at 24% today, it is 32%. You will get tax rate advantage in that given year when you sell that property, not when the loss was occurred. So let's say loss occurs today when you're in a 24% tax bracket, but you get to deduct that when you are in a 28 or 32% tax bracket.
Yes. Let me clarify my question. So let's assume you are positive, you're getting positive passive income. There's no loss. Is that passive income taxed at your regular rate?
Correct.
Or it's a different rate?
No, your individual tax rate.
Okay, last question, I promise, guys. Let's complicate a little bit. So let's say I invest into syndication from my self-directed IRA.
Mhm.
In that case, all of my income distributions, they roll into my IRA. I cannot touch it, and it grows tax-free. Great. The depreciation in that case, or let's say I bought a rental property with my self-directed IRA, and I hired property management and stuff like this. So I'm doing arm's length as much as I can. How does the depreciation then works in that case? The same way?
Yes, the same way. But you said it's something, I will let it grow tax-free. No, with your IRA money, you let it grow tax deferred, not tax-free.
That's right.
Okay, just wanted to correct you on it. So let's say you have $200,000 in your IRA today that you want to put in a real estate. Now, if that is in a partnership like the syndication one, then you will just get a K1 that will show the value of your IRA go up or down. Just like you have a 401k with Microsoft today. If the Microsoft 401k shows a balance of 200k, if the stock has gone up, it will show 210 the next day, or vice versa. Same thing with the self-directed IRA. It is no reporting required till you take a distribution on that IRA account. It is just going to be a fluctuating number, up or down. And that depreciation that you said, so the value that will go up with that net rental income, and it will go down with that net rental loss, which includes depreciation already. So if you invested 200,000 of your self-directed IRA in a real estate, that 200,000 has been invested in a 1 square building, let's say. Okay, and that building that paid its bill will collect its rent. Whatever is left after paying everybody, including taking into account the depreciation, will make your IRA account value go up or down.
Okay.
So depreciation goes hand in hand. It's not a separate element of this net rental income or net rental.
So even though depreciation is a fake thing, like for example,
it's a tax deduction, while
right,
you,
but it will
while you
reduce
as an
my
investor,
IRA value.
Yeah, so while you as an investor, and people do with their IRA money, they will do buy stocks. It's the same implications. But with real estate, this is you will say a loophole maybe that IRS has given you while you enjoy that appreciation of a property. You can deduct this while your equity is building. But once you have built up that equity, it's time to pay back not just the profit, but a little piece of that profit. But I tell you this much, if you look at the numbers, I wish I had a board here. If you say it's $100,000 of rent that you're receiving after paying every expense, including taking into account depreciation, today you are not paying taxes on that money is because of depreciation. So what when my $100,000 of an investment grows up to $400,000 and I only have to pay them that tiny bit back? I have enjoyed the tax-free time for those 5-year period. So you're already ahead in the game with the IRS on this one. Meaning you have gained and you have enjoyed those 4 or 5 years where you had to pay no net rental income on your tax returns.
That's right. Okay, I'm done. Sorry. Thank you.
Any
Hey,
other questions from anybody else?
Yes. Hey, Sumi, I have a question. So think about this scenario. I purchased a house for 5 years, a rental property, and I have 100K capital gain. However, I also have a negative cash flow considering about the depreciation and also rental loss. So the total is 20K.
now I'm going to sell it. So how much capital gain I should pay for that?
So you bought it for 400K or you're selling it for 400K?
No, just think about I have 100K capital appreciation value.
Okay, so that appreciation value of 100K, number one, will be reduced by the selling expenses that when you're selling the property, it's around, in Washington state, it's around 10% or shy of 10%. So that will bring it down to probably $90 or $88,000 of a gain. Then those passive losses that you were holding for those years that you have enjoyed that depreciation will also be deducted against this 100K. So when you sell a property, there are two taxes. There's an ordinary tax. An ordinary tax is against depreciation recapture and your passive losses. And whatever that is gets as a minus number on your return. And then that 100K of a gain in your example will get taxed at a long-term capital gain tax rate of anywhere from 0 to 20%. So you will have a one big negative number and then another positive number of 100K to offset each other, but they both will be taxed at different rate. One will be taxed at your ordinary income tax rate. The other one will be taxed at your long-term capital gain tax rate.
1 second, can you explain the depreciation recapture? How does it work? And like she said, when there is a rental night loss.
Yeah, so if she has rented it out for 5 years, the original cost basis of that property, plus any improvements that she have made, and you divide that over 27.5 years times the 5, because she's only taken it for 5 years, will be your depreciation recaptured at 25%. Or the other way you could look at it, you can have your tax professional provide you with a depreciation schedule. And that schedule will have that 5-year accumulated depreciation amount that you will know you will need to pay this back. But do remember that depreciation recapture will offset against your passive losses that you have too. So unfortunately, we don't have like a flat tax rate where it's just one item times the rate. No, there are tiers of different items get taxed at a different rate. So that depreciation for that 5-year period, whether it's 10,000, 20,000, 30,000, will get taxed at a 25% rate, but it will also offset against your passive losses.
And the rest of the gain is just the long-term capture gain.
Correct.
I see.
But if when I sell this house, I don't, I do a 1031 exchange and then use this capital gain to purchase another home, then I'm exempt for all the capital tax, capital tax, right?
If the investment is entire, you are selling this for $400,000 and you're putting the entire $400,000 in your new exchange, the new home, the new replacement property that you're buying. Let's say you are selling something for 400K and you're buying a new one for 300K, then the 1031 exchange will only be for 300K and that 100K will still be taxed to you as a boot received or cash received from the sale.
So I'm a little bit confused here. So if I sell this property for 400K, but I also needed to pay for the mortgage for the bank.
Okay,
Maybe
IRS does not look at any of these real estate transactions and how much debt you are in. They look at how much capital gain you are having from your purchase price minus the selling price in plain English. That's the way I'll say it. It's your basis versus the selling price. Meaning if you bought something for 100,000, you're selling it for 4, you have a gain of 3. That entire amount has to be reinvested.
I see. So if I reinvested, then I have to, that basically means I have to purchase a property higher than my current property.
Yeah.
More
higher,
expensive.
Yes, higher will be the smart move, or at the same range. Or if you do less, at least you have taken, most of your over 70% of that gain is already been deferred now, and you're just paying tax on that 30%. So if you sell something for 400K and you're only investing 3K, regardless of how much in debt you are, the mortgage that you are being relieved by also gets carried over on the new 1031 with the new replacement mortgage. So a 1031 normally takes us a good 2 days or so per property to figure out all the schedules, because the debt goes separately from the gain on the property. So how much in debt you are versus what is being paid off and what is being carried over also get accounted for to come up with your new basis in that 1031. Your old basis will go away when the 1031 is completed. When the new basis of the new property, how much was the replacement value, how much of the debt carryover was it, those all get added into this new 1031 number.
Thank you.
Hope I didn't confuse you, but I tried my best.
Any other questions? I think we are running a little bit late, almost 8:30. One thing I do want to share, at first, because it's already running a little bit late, maybe we're not going to do ask and offer today. But one thing is people ask about how to keep in touch. You can continue going to the meetup group. Also, we share, I think Josh shared where's that? The chat window, but people ask about a Facebook group. So we create a Facebook group here. So if you're interested, and then you can join the Facebook group, and then you have questions, you can just ask there. And then Sumit, also, if you have your info you want to share with people, maybe you can put it in here in the chat window. So I know people may still have some follow-up questions they can ask you directly.
And you can also subscribe to my, I'll put in my my website address, and you can subscribe to my newsletter. Every month a newsletter goes in, and you sure can subscribe to that. It's free of charge. It's no binding whether you are my client or not, and it can give you updates on new laws, new rules, what the tax brackets are. It has a lot of financial calculators on it, from business standpoint, from real estate standpoint. So I think it will also be a helpful tool. And if you visit my website, it will have my email address, my phone number, contact information. So you can always reach out to me via that too.
Perfect. Yeah, thank you, Sumi, for today, for sharing so much great information about real estate and the tax.
Sure, sure, my pleasure. Thank you.
Hopefully people will continue joining us next time. For December, what we are thinking, Josh and I were thinking about to do some year-end planning. So thinking about how to kick off 2021. So we are going to share some tips about all different kind of stuff. Like I always do 12-week year. So every 12 weeks is a year, so I can share my planning stuff. And we welcome anybody who want to share their way, how to get motivated and then get productive throughout the year. And anyway, perfect. Thank you again, everybody.
Thank you.
Thanks.
Thank you, Nick. Have a nice day.
Have a wonderful evening.
You are.
Have a good night. Thank you.
Thank you.